Okay. Good day, everyone. Today we're going to discuss the analysis of the unadjusted trial balance. This time we're going to adjust the second account and the third account, which is the accounts receivable and allowance for doubtful accounts. Accounts receivable is also known as trade receivable. It is a right to receive from a customer the amount of services or goods delivered. It is a current asset account and debited for goods or services provided on credit and billed in sales invoice. When the business receives an amount that was due on its accounts receivable, cash will be debited and accounts receivable will be credited. Accounts receivable has a normal debit balance. The accounts receivable shall be adjusted to reflect actual collectible account. It is an accepted reality that not all credits given to customer will actually be collected. Therefore, allowance for this should be set up. Bad debts expense is recognized to set up allowance for uncollectible accounts. Let's analyze the unadjusted trial balance of the Rimacor drugstore. It can be noticed that the accounts receivable has no adjustment yet, without allowance for doubtful accounts. It is presented as 100% collectible, which may be a reality or not. Let's talk about bad debts. Bad debts expense is related to a business current asset accounts receivable. Bad debt, also known as uncollectible accounts or doubtful accounts expense, result when the business delivered goods or services on credit and the customer did not pay the amount owed. It is a monetary amount owed by a customer that is unlikely to be collected because the customer has no means to pay or his residence is no longer determinable and that collection processes cannot be enforced against him anymore, or any reason that collection will be impossible. There are two methods of recording bad debts. Uncollected cash from credit sales can restrict a company's cash flow. If delinquent customers fail to respond to collection efforts, two accounting methods are used to recognize the loss from the sale: the allowance and the direct write-off methods. Although each method varies in its approach, both are used to remove the uncollectible amount from the accounts receivable balance so that the account reflects only the amount that is more likely to be collected. So direct write-off method is simple. A company writes off the debt once it becomes certain that the amount will not be collected and all collection efforts have not yielded favorable results. When the account is written off, the company will expense the uncollectible amount as bad debt and remove the receivable from its book. In this example, there would be no expense to be recorded every period, except when there were actual failure to collect the amount due from customers. If in January it was not evident the collection was impossible, there would be no entry to record the expense. In direct write-off method, expense for bad debt is recorded only when collection becomes evidently impossible. So if here we have Dr. Guevara who failed to pay the accounts due from him, so we're going to debit bad debt expense and credit accounts receivable. But if there's no showing that Dr. Guevara will not be able to pay his credit, then there will be no entry for this. Not even an allowance, because this is direct write-off method. So you see, the process in direct write-off method is like this. You sell an account, then you have your account receivable. But the customer was not able to pay, therefore you debit the collectible as a bad debt expense. And then you write that off. You credit actually here accounts receivable. So debit bad debt expense, credit accounts receivable to write off the receivable for that account. So the other method is allowance method. Unlike the direct write-off method, the allowance method records an expense to bad debt using an estimate of accounts that are unlikely to be collected before the specific customer are identified as being specific customer accounts are identified as being uncollectible. So even before the evidence that collection will not be pursued, there has already been provided allowance for the uncollectible accounts. So the estimate is determined by management, and it is based on percentage of accounts receivable or sales. The percentage rate may be based on historical trends, economic trends, or other form of measurement. So it's a management decision to set up the percentage of accounts receivable or sales as allowance for doubtful accounts. So in the allowance method, this is the flow of transactions or events. You have the sale on account. If the business sold an account, then it had accounts receivable. Now the question, it becomes uncollectible. Now, is it collectible or not? Even if it's collectible, we set up allowance. So the allowance will be based on percentage of sales or percentage of receivables. So you debit the bad debts expense to set up the allowance and credit allowance for bad debts. Take note that we do not right away deduct the amount from the accounts receivable. So here this one, we have the account bad debts, expense, and then allowance for bad debts. Let's go back to the previous one, which is the direct write-off. So in the direct write-off, you have bad debts expense. This one is accounts receivable actually. So this will be accounts receivable. Since this is a direct write-off method, you do not credit allowance. You credit the account receivable right away. So we go back to this topic. To maintain the estimate of accounts that will become bad debts, the allowance method uses a contra account to accounts receivable called allowance for bad debts or allowance for doubtful accounts or allowance for uncollectible accounts. So this one is a contra to the accounts receivable, meaning to say to get the net realizable value of the accounts receivable, you have to deduct this allowance for bad debts. To illustrate the allowance method, assume that Terimacor estimates its bad debt at 3% of accounts receivable. At the end of the month, the balance in accounts receivable is 10,000, and the allowance for doubtful account has a zero balance. The entry to record the estimate is as follows. Bad debt, which is 3% of 10,000. Bad debts expense, which is 300, will be debited and a credit to allowance for doubtful accounts. So you can see here, debit bad debts expense, credit allowance for doubtful accounts, or allowance for bad debts. Allowance for bad debts. You can use this bad debts. Now, that is an allowance whether the account is collectible or not. You will set up the 300 every end of the period. Not actually 300, but 3% of the accounts receivable. That will be the allowance every end of the year. Now, 3 months later, Core decides to write off 5,000 of Dr. Guevara's overdue invoice. The entry to record the write-off is as follows. So, you first debit the allowance for doubtful accounts. You can no longer debit bad debts expense because this bad debt expense has already been recorded in the allowance. So, what you're going to debit now is the allowance, and then you credit the accounts receivable. You see the difference between this method and the direct write-off? You debit, in the direct write-off, you debit the bad debts expense and you credit the accounts receivable right away. But in this method, allowance method, you debit the bad debts expense and you credit the allowance for bad debts. Now, if there is evidence that that collection cannot be made against customers or a certain customer, then the allowance method will be debited, not the bad debts expense. And the same credit accounts receivable. So, if this is the entry, we already have an allowance on the previous month, not 300 pesos. Then, there is a debit of 5,000 pesos. This entry adjusts the balance of the allowance account to a debit of 4,700. So there is a debit balance in the allowance for doubtful accounts. So in the ledger, it would appear like this. This illustration shows the ledger balances of accounts receivable, bad debts expense, and allowance for bad debts. Note that the allowance is 3% of the accounts receivable balance. Hence, 300 was debited on the bad debts expense and credited to allowance for bad debts for the first month. If on the second month, Dr. Guevara can no longer be found and his credit is 5,000, then that 5,000 will be debited to the allowance for bad debts and credited to the accounts receivable. So what's going to happen is that you have a 4,700 debit balance. But the policy of the business is to have a 3% allowance, 3% accounts of the accounts receivable as an allowance. So you're going to maintain the 3% of the accounts receivable. How much will be the journal? How much will be the adjustment? How much will be the allowance? So when Dr. Guevara went abroad and can no longer be found, the 5,000 becomes an actual debt expense and not merely an allowance. Therefore, this amount should be considered as an expense and should be removed from the accounts receivable. Considering that what is being used is an allowance method, bad debt expense account is not right away debited but the allowance for doubtful account. Remember that there has already been recognized bad debt expense of 300 at the beginning of the period when the allowance was set up. at the end of the first period. This is the difference between the direct write-off and allowance method. In direct write-off, the actual uncollectible amount is directly charged against the bad debt expense. In the allowance method, the actual uncollectible account is charged against the allowance for bad debt account. And the actual expense for the bad debt will be recognized at the end of the period when a new allowance is set up. To set up the 3% allowance here, you have to debit not the 5,000 because there has already been provided 300 before, but to maintain the 3% on the 5,000, you will have to have how much? 150. So the balance at the end of the period on allowance for uncollectible accounts should be 150. But considering that there is already 500 debit and 300 credit, how much is the difference to make it 150? So to make it 150, you have to debit it by 4,850. So the journal entry will be debit bad debts expense 4,850 and allowance for bad debts credit 4,850. So you will have 3% of the remaining balance of the accounts receivable. 3% times 5,000 will be 150. 150 plus 4,700, that becomes 4,800. So at the end of the period, but before recording the adjustment to allowance for bad debts, the allowance for bad debt accounts will have a debit balance of 4,700. The allowance for the period is said to be 3% of the accounts receivable. So the remaining balance will be 5,000 because the original amount was 10,000. Then uncollectible from Dr. Gibalda is 5,000. So you have 5,000. So you will get the allowance again as 3% of the remaining receivable, which is 5,000. So dapat talaga this is 150 at the end. So to make that 150 with a debit of 5,000 and with a credit of 300, you have to debit it, the expense, and credit the allowance by 4,800. Is this clear? Number 23, is this clear? Okay, we will go to the next. In the allowance method, as earlier discussed, the estimate is determined by management and is based on either percentage of accounts receivable or sales. The percentage rate may be based on historical trends, economic trends, and some other forms of measurement. So in the allowance method, as earlier discussed, the estimate is determined by management and is based on either percentage of accounts receivable or sales. The percentage rate may be based on historical trends, economic trends, or other form of measurement. The percentage of receivable method focuses on the balance sheet and the relationship of the allowance for uncollectible accounts to accounts receivable. So in a percentage of receivable method, you are basing the relationship on the uncollectible accounts with the accounts receivable. So one way of computing for the estimated value of bad debts under the allowance method is to calculate the bad debts as percentage of accounts receivable balance. If the RIMACOR has 10,000 receivable balance at the end of the accounting period and the business records indicate that on average 3% of the total accounts receivable cannot be collected, the allowance for bad debt account must be adjusted to have a credit balance of 300 or 3% of 10,000. So in the Tirima core problem, we have 10,000 and the allowance daw is 3%. So 10,000 times 3%, that becomes 300. That is on the first period. In this one, we have not set up the allowance yet. So as an adjustment to the accounts receivable, we are going to record what could have the allowance to arrive at the net realizable value of the accounts receivable. So I've already discussed the allowance based on receivable. This time, it is allowance based on sale credit. So if write-offs were less than expected, the allowance account will have a, if the write-offs, meaning to say the uncollectible, were less than expected, the allowance account will have a credit balance. If the write-offs are greater than the allowance will have a debit balance. So in our example here, in the first period, the allowance, there was no write-offs, there was no actual uncollectible account. Therefore, this 300 is on the credit side. Let's go back to that. The 300 is on the credit side. Pero in this example, where there was write-off of 5,000, the balance becomes a debit. So that's the meaning of this illustration. When the allowance is greater than write-offs, the normal balance of the allowance is credit. When the allowance is lesser than write-offs, the balance of allowance is debit. So, based on the method of using percentage of receivable, there is also what you call aging of receivable. In general, the longer an account balance is overdue, the less likely the debt is to be paid. Therefore, many businesses maintain an account receivable aging schedule. So this is an account receivable schedule, aging schedule. So this is current, 1 to 30 days past due, 31 to 60 days past due, 61 to 90 days past due, or past due over 90 days. And how much of that current account will be subject to 8%? How much of that 1 to 30 days will be subject to 10%? So these percentages are predetermined, and it is being applied on the classification of accounts. So you arrive at an estimated budgets based on different rates for different status of accounts. Each category's overall balance is multiplied by it. This balance is, each total is multiplied by estimated percentage of uncollectible account. The total of such calculations shall serve as the bad debts expense. So in here, 5,000 will be the bad debts expense. Now, so we go to the next, or the estimated budget is 5,000. So if the estimated budgets here, we correlate this with Terina Core Drugstore. For example, this is the uh, succeeding periods accounts receivable. And then the estimate we have already a balance of 300 in the Terima Core. Then we have an estimate of budgets 5,000. Then we have an adjusting entry of 5,000, 4,700. So the adjusting entry includes bad debt, debit to bad debts expense as 4,700 and a credit to allowance for bad debts as 4,000 because we have to come up with the 5,000 ending balance. So in our ledger, we have to have an ending balance of 5,000. But considering we already have a credit of 300, therefore the adjustment will be 4,700. So it's not 5,000. Although 5,000 is the estimated budgets, but we have already a balance of 300. So we have to adjust the balance. So the ending balance should be the estimate based on receivable. So that will be the this one, the estimate, which is 5% of the total accounts receivable at the end, but there has already been debited 300, therefore 4,700 will be the adjustment to accounts receivable. So ito yung entry. Debit bad debts expense 4,700, credit allowance for bad debts 4,700. Explanation, bad debts estimated for the period. So we've already discussed percentage of accounts receivable method of setting up of bad debts allowance. Now I'm going to discuss another method, which is percentage of credit sales method. So this is not widely used. What is being widely used is the percentage of accounts receivable. But we're going to discuss this for purposes of illustration. So the formula here is to determine prior period's actual uncollectible accounts over prior period's credit sales. So you get the percentage of sales allowance for uncollectible accounts. The bad debts expense will be computed as net sales, total or credit, times percentage estimated as collectible. So this is the percentage taken, and then it should be applied on the net sale, either total sales, including cash sales or credit sales. The percentage of sales method estimates uncollectible accounts from the credit sales of a given period. The percentage of sales method focuses on the income statement and the relationship of uncollectible accounts to sales. So instead of being related to accounts receivable, it is being related to sales. In theory, the method is based on a percentage of prior year's actual uncollectible accounts to prior year's credit sales. When cash sales are small or make up a fairly constant percentage of total sales, firms base the calculation on total net sales, since at least one of these conditions is usually met. Businesses commonly use total net sales rather than credit sales. The formula to determine the amount of the ending estimated bad debt entry is bad debt expense is equal to net sales times percentage of uncollectible. So to illustrate, let us assume again that Terimacore estimates uncollectible accounts at 1% of total sales. So yung total sales, for example, there is a credit sales of 50,000 and then the allowance rate is 1%. So the allowance for budgets will be 500. So you debit budgets expense, 500, allowance for budgets, 500. So the accounts receivable will have, so the allowance for doubtful account can either have a debit balance and a credit balance also, just like in the allowance for accounts receivable using percentage of receivable. Under the percentage of sales method, the company ignores the existing balance. So let's take a look at the balance of Terimacore. Before, it has 5,000 balance sa accounts receivable. Then sa allowance, it has balance of 300. Now, for the current period, there is a 4,700 debit balance. Under the percentage of sales method, the company ignores the existing balance in the allowance when calculating the amount of the year-end adjustment, except that the allowance must have a credit balance after adjustment. So in this case, it is a debit balance, you should make it as a credit balance. In applying the percentage of sales method, the business usually reviewed the percentage of uncollectible accounts that resulted from previous year's sale. If the percentage rate is still valid, the business makes no change. However, if the situation has changed significantly, the business increases or decreases the percentage rate to reflect the change condition for the period. So, for example, in periods of recession and high rate of unemployment, like this pandemic, a firm may increase the percentage rate to reflect the customer's decreased ability to pay. However, if the business adopts a more stringent credit policy, therefore there will be a decrease in accounts receivable, it may have to decrease the percentage rate because it is expected to have fewer accounts receivable. So in this example, the 300 is there, and then the adjustment is how much? 1% of the 1% of the of the sales. So the sales is 50,000 and 1% is 500. So we're not going to maintain 500, but we're going to add this to the balance. So we're going to have 800 as balance. What if it's based on accounts receivable? So you will have the 500, and then the adjustment will be how much? In this one, the adjustment is 1%. To maintain that adjustment, 1%. But as an adjustment, not as a balance. In accounts receivable, the 1% will be the balance. We have already discussed the setting up of allowance when the ending balance of the previous is credit. So this one, you have a credit balance, and then you have the 1% of sales. So you have 500, you add that up, you have an ending balance of 800 for your allowance for budget. So if you have an accounts receivable of let's say 5, in our example 10,000, the Terimacore has an accounts receivable, let's say of 10,000, and then allowance for bad debts as 800. So the net realizable 800. The net realizable will be 9,200. So in the presentation of financial statement, what could be collected will only be 9,200. So we've already discussed that, no? When the balance is credit. What if the ending balance is a debit balance, just like when Mr. Guevara could not pay his obligation? So what would be the adjustment? How much would be the adjustment? How much would be the balance? To remedy this, the percentage of doubtful account is based, which is based on sale. The the percentage should be increased to eliminate this one. So instead of 1% of credit sale, then you can make 50% of credit sale to allow some allowance and to eliminate the the debit balance. So we have to eliminate this debit balance. So what would be an amount that would provide an allowance and at the same time would eliminate this debit balance? Then that would be the remedy when what is being used is percentage of sales method. But this method is no longer used. What is being used now is the percentage of accounts receivable. So in our example, the rate of of the rate of the allowance will be increased to cover this one. So if we have a sales on account, the basis is sales on account. So it's not the balance of the accounts receivable. In this case, the credit sales is 10,000 and the balance is 5,000 because the 5,000 is already uncollectible. So where are you going to base the rate of allowance? It will be based on the 10,000. So you can have a 50% rate. So if you have a 50% rate, then you have 5,000. So this 5,000 will cover 4,700 and will provide a balance of 300. So this is not widely used because you have to consistently monitor if it's just like having to adjust every now and then your rate. You will not have a constant rate in this kind of allowance method. But in the accounts receivable method, you can have a constant rate. If it's 3%, you can maintain that for a long period of time for us, whether there is a debit balance or a credit balance. In this case, if you have in the percentage of sales, when you have a debit balance in your allowance for bad debts, you have to adjust your percentage of sales. So the next item will be the notes receivable. So what are the things we're going to look into the notes receivable to adjust? What are the transactions hidden in notes receivable? We've already analyzed the transactions hidden in cash or internal transactions in cash. So we have internal transactions in cash, setting up of petty cash fund and shortage. So these are transactions which do not have source document, but it impacts the financial position of the business. So this must be journalized. So we have already discussed the accounts receivable adjustment, which is the allowance for doubtful account. The allowance for doubtful account has no source document. But this impacts the financial position of the business, reducing the accounts receivable, the realizable value of the accounts receivable. Now, on this third item, which is notes receivable, what are the internal transactions here? What are the unrecorded transactions in notes receivable? So, sometimes a company, this is the illustration of notes receivable. Sometimes a company receives a note when it sells high-priced merchandise. More often, a note results from the conversion of an overdue account receivable. When a customer does not pay an account receivable that is due, the business may insist that the customer gives a note in place of the account receivable. This action allows the customer more time to pay the balance due, and the company earns interest on the balance until paid. Moreover, the company may be able to sell the note to a bank or to other financial institution. This becomes a negotiable instrument. So this is the amount, principal amount of the note. Then, this is the duration of the note, 4 months. And then, this is the interest on the note. So, the interest is always expressed in terms of year. So, when you find an interest on a note, usually it is an annual interest. So, take note of the duration or the period of the note, because this should be computed based on the duration and not on the annual, not per year. So take note of that. 9% per year. But this is only 4 months. How much will be the interest income? Most promissory notes have an explicit interest charge. Sometimes this one is not written. So this one is explicit because it is written here. So interest is the fee charged for use of money over a period. So for the use of money for 4 months, the RIMACOR will be given 9% by Dr. Kiginding. So to the maker of the note, this Dr. Riginding is the maker of the note. It is to the maker of the note, it is an expense. If Dr. Riginding has a business, she could record it as an expense. Now, from the point of view of the RIMACOR drugstore, this is an income. The borrower incurs interest expense, and the lender, the RIMACOR, generates revenue. So, for convenience, bankers sometimes calculate interest on a 360-day year. We calculate it on that basis in this presentation. So, we're going to use 360 days. Some companies are using 365-day year. So for our computation, we're going to use 360 days. So what is the formula for computing the interest? So the basic formula for computing interest is principal times interest rate times frequency of the year. So that becomes your interest. It's either an income or a revenue, depending on the point of view, or who's having who issues and who receives it. The frequency of a year means the duration. So this is the frequency of the year. So this is the interest rate, and this is the principal. So principal times rate times frequency. So this is 4 months, 4 over 12, because there are 12 months in a year, and the period is expressed in months. So that will be 4 over 12. 1,000 times 4 over 12 times 9%. That will be the computation. So we have this 1,000 times 9% times 120 over 360 or 4 over 12. So you have 30 pesos interest. Okay. When does the note mature or when is it payable? The maturity date is the date on which the note becomes due and must be paid. Sometimes, notes require monthly installments or payments, but usually, all of the principal and interest must be paid at the same time. The wording in the note expresses the maturity date and determines when the note is to be paid. A note falling due on a Saturday or on a Sunday or holiday is due on the next business day. So in our example, you compute when June 24, 2020, 4 months after June 24, 2020, when will that be? So that date will be the due date of this note. It should be paid on that day. But what if it will not be paid on that date? Okay, now before that, we go to the examples of the maturity date wording. On demand. On demand, I promise to pay. When the maturity date is on demand, it is at the option of the holder and cannot be computed. On demand. So, on demand, you demand it, then that is the due date. So, it's indeterminable. It depends on when the payment will be demanded by the payee. So, on stated date, on July 18, 2015, I promise to pay. When the maturity date is designated, computing the maturity date is not necessary because it is already indicated when it becomes when it matures. So, at the end of a stated period, so if there is a period given, like this one, 4 months after date, then after 4 months, from June 24, then that will be the due date. So these are the different wordings in a note. Not all notes are the same. So take note, if it's on demand, it is only when demand is made that it becomes due. If there is a stated date, in this one, this is not the stated date. In our example, June 24 is not the stated date. This is the date of execution of the promissory note. The stated date is the 4 months after date. Okay? So we'll go to the different wordings pa rin yan. So, let's see. This 90 days after date, it's just like the 40 days after date that we have in the note. I promise to pay. When maturity is expressed in days, the exact number of days must be counted. The first day, the date of origin is omitted, and the last day, maturity date, is included in the count. For example, 90-day note dated October 19 matures on January 17 of the next year. So we compute this is a 90-day note. So 90 days, but the date is dated January 19. So from January 19 to 31, how many days? So 12. How many days in November? 13. How many days in December? 31. So you total that, you have 73. 73 minus 90, so the maturity date is October, November, origin of note is October, November, December, January. So on January 17, it becomes mature. So 1 year after date, I promise to pay. When the maturity is expressed in years, the note matures on the same day of the same month as the date of the note in the year of maturity. So if it's January 1, 2001, it will mature in January 1, 2002. Or January 1, 2020, it will mature in January 1, 2021. So this illustration, 4 months after date, I promise to pay. When the maturity is expressed in months, the note matures on the same date in the month of maturity. For example, 1 month, July 18. For example, 1 month from July 18 is August 18. 2 months from July 17 is September 18. If a note is issued on the last day of the month, and the month of maturity has fewer days than the month of issuance, the note matures on the last day of the month of maturity. A month note dated January matures in February 28 because it is expressed in months. So, in our example, let's go back 4 months after date. So, it will be June 4, July, August, September, October. So October 24 will be the due date of this note. So the due date on October 24, Dr. Riginding should pay the 1,000 plus 30 pesos interest. So 1,030 pesos. So what else we have? Conversion of an accounts receivable into a note. To illustrate the conversion of an accounts receivable to a note, assume that the Rimacor had purchased 18,000 of merchandise on August 1 from Macoral's company on account. The normal credit period has elapsed and the Rimacor cannot pay the invoice. Macoral's agrees to accept the Rimacor's 18,000 for 15% 90-day note, dated September 1 to settle the Rimacor's open account. Assuming it paid the note at maturity and both have a December 31 year end, the entries on the books of Macorals are accounts receivable, debit, on the date of sales. Let's review the first transaction. Accounts receivable, the Rimacor, 18,000 credit sales to record the original transaction, which is the sale of merchandise on account. Now, the account was changed into a note receivable. So, what the note is debited for 18,000 and accounts receivable was credited to 18,000. Now, when the note was encashed, the record will be, the entry will be a debit to cash, the principal plus interest, 18,675, and then credit the principal of the note, which is 18,000, and the credit to interest revenue. Okay? 18 times 15% times 90 over 360 have 675. So, this is when the note is demanded to support an account receivable. So, from being a character loan, it becomes a guaranteed loan because there is a note supporting that loan. So, a note receivable provides some sort of guarantee to an account. Okay, this is the explanation of the maturity date. Maturity date calculated as November 30 since it was a 90-day note. 29 days left in September, 30 days in September, note day September 1. So 31 days in October leaves 30 days remaining in November. The 18,675 paid by the Rimacor to Macorals is called the maturity value of the note. The total, I call that the maturity value of the note. Maturity value is the amount that the Rimacor must pay on a note on its maturity date. Typically, it includes principal and accrued interest, if any. Sometimes the maker of a note does not pay when the note becomes due. The next presentation describes how to record a note not paid on maturity. So it becomes a dishonored note. Dishonored note is a note that the maker failed to pay at maturity. Since the note has matured, the holder or payee removes the note from notes receivable and records the amount due in accounts receivable. It will be reverted back to accounts receivable. From accounts receivable, it becomes notes receivable. But because the payer was not able to pay the notes receivable, it becomes an accounts receivable again. At the maturity date of a note, the maker is responsible for the principal plus interest. The payee should record the interest earned and remove the note from its notes receivable account. Thus, the payee of the note should debit accounts receivable for the maturity value of the note and credit notes receivable for the note's face value and interest on the note. So this will be the illustration. Debit accounts receivable again, 865, this time with interest. Credit notes receivable and credit revenue. This is for dishonored note. Otherwise, this would be cash and credit notes receivable. And okay, that is done for today. I hope you learned. Number 23, did you learn from this discussion? I hope so.